here again with Smart System. In our last lesson, we looked at the difficulty of overcoming trading losses. To further emphasize the importance of protecting one's trading capital as a key component in any successful trading strategy. In today's lesson, we're going to begin to build a strategy for money management with a look at one of the first components of this, setting your initial stop. As we learned about in lesson on the effect of trading losses, many successful trading strategies have a success rate of less than 50%. With this in mind, these strategies and these traders are successful, not because of their high rate of accuracy on an individual trade basis, but because of their ability to recognize when they're wrong and cut their losses, and on the flip side of that, to recognize when they're right and let their profits run. While the strategy you end up, or you're trading now, may have a success rate of higher than 50%, any strategy is gonna have losing trade. So one of the first keys to staying in the game is having a plan for what you're going to do and how you're gonna exit the market if the market does move against you. With this in mind, where most traders will start when developing their money management strategy is by determining how much money they're willing to risk on a poor trade basis. While this is gonna vary from strategy to strategy and from trader to trader, as Dr. Alexander Elder points out in his book, Trading for a Living, many studies have been done which show that traders who risk more than 2% of their account balance on any one trade are rarely successful of the long term. The fact that most traders do risk more than 2% of their account balance is another contributing factor to the high failure rate among traders. So traders who set their per risk trade level at 2% or less not only decrease their chances of being knocked out of the market because they can sustain themselves through a fairly lengthy string of losses, but also put themselves in a situation whether one trade is not going to make or break them. This is not only important for a money management standpoint, but it's also important for my psychological standpoint, because it puts the trader in a position where they're not overly attached to any one trade, in order to have a true understanding of what this number should be. For a specific strategy, you really need to have an understanding of what the expected accuracy rate is for that strategy, something which we're going to cover in later lessons. For now, however, it's simply important to understand that the first step in designing any successful money management strategy is to determine what your risk level is on a per trade basis in relation to your overall account balance. So now that we have an understanding of this, we can move on to some specific strategies for setting stops, which fit within this initial guideline, which we're going to cover in next lesson. So that's our lesson for today. As always, if you have any questions or comments, please feel free to leave them in the comment section. And good luck with your trading. Have a great day.